I recently spent some time on a conference covering both the US and Europe. Interestingly, in the US, we met with the US Federal Reserve, obviously a great opportunity to talk to them directly. And one of the key things that we wanted to talk about and get a better sense for was just their mindset around, they very well telegraphed the fact that they intend to take their time to raise rates. What we wanted to talk about was really, get some more granularity on why they're being so pessimistic and being so, they're so paranoid about the prospect of raising rates too soon. Clearly, one of the big issues for them is the rate of growth of jobs and perhaps not believing that it's as strong as what the market's confirming. Now, when we spoke to other participants in the market, they were very clear that the US economy is doing well, job growth is coming through, wages are starting to rise, and the service sector in particular looks pretty strong. So, in terms of what the Fed's looking to do, we're, I guess, a little concerned that the Fed might fall behind the curve, and consequently, will have to raise rates a bit more aggressively if they wait too long to get started. So turning to Europe, the meetings in Europe, and we met with the European Central Bank and quite a few other market participants. The interesting thing about Europe is it's a real dichotomy of different countries performing at different speeds. Interestingly, countries like Ireland and Spain that really took their medicine during the GFC and the European crisis, who went through great structural reform, are really starting to do quite well. Conversely, looking at, say, France and Italy, for example, who resisted structural reform, they're really starting to struggle to keep their economies out of recession. From our perspective, what that really means is from an investment process, you really need to be quite selective about your investments in Europe, and we believe that the way to do this best is to really focus on investments that are backed by hard assets. When you look across Europe, hard assets in a lot of areas have fallen significantly in value, and so using those low valuations on good asset security valuations provides really good downside protection in terms of thinking about the best places to invest. In terms of the positioning of the fund, we currently hold approximately 50% of the fund in cash, so we've got a lot of capital up our sleeve to take advantage of investment opportunities as they come along. Looking at the US, the prospect of higher rates over the medium to longer term and the potential for asset prices to come down somewhat if the Fed does fall too far behind the curve really puts us in a great position to invest capital, and the likely scenario is in that sort of environment the invested position of the fund will increase quite substantially. Looking at Europe, like I say, we're focusing on hard asset plays, so we do have that downside protection there because Europe's a little bit of a tougher case to analyse. So consequently, we'll be focusing our attention on things like asset-backed and secured securities, where you do have that hard asset backing in the event that markets get a bit more volatile. It's worth noting also that we have basically no interest rate exposure in the fund, and looking at our view on rates longer term and the likelihood that the interest rates will increase and most likely quite substantially, that does two things. First of all, it protects the capital value of assets in the fund, but also as rates rise, we have the ability to reinvest capital at higher interest rates. So in actual fact, from an interest rate perspective, that should actually contribute to, even though rates are going up, that should contribute to the longer term return on the fund. Look, we've had a number of questions asked over the quarter from clients with regard to our exposure to hybrid securities in the PM Capital Enhanced Yield Fund. Basically, there's roughly 15% of the fund in hybrid securities at the moment, split broadly equally between bank and non-bank hybrids. And it's really the bank hybrids that most of the questions are coming in about. Standard & Poor's has obviously been quite active of late, changing the ratings on some of these securities for the lesser. And so it's worth just highlighting the sorts of assets that we own. Basically, our bank hybrid securities, for the most part, are significantly more shorter dated. The well, I guess roughly 75% of the assets mature in the next sort of 12 to 18 months. So that gives us some pretty good downside protection, and in that it reduces the volatility in those securities. But also, and equally as importantly, they don't contain a lot of the terms that are being sort of marketed around in the more recent securities, where you have issues with things like non-viability and the potential for certain yield securities. And I really can't understand how this has been allowed to creep into these securities. But you've got a term whereby in some cases they can actually be wiped out before equity, which just seems absurd. So we've really tried to focus on the better quality, more, I guess, older style hybrids that we think will stand up much better in any sort of deteriorating environment.